All right, in this video, I'm covering two separate things. First, how to buy real estate inside your retirement account, and second, how to take money out of your retirement accounts to buy real estate separately. If your goal is to buy real estate within a retirement account, typically the easiest path to do this is by using a self-directed IRA. So let's go through how to do that step by step. A self-directed IRA is not like a normal IRA from Fidelity or Vanguard. This is an IRA that the IRS requires you to set up with a custodian. So there are companies that specialize in being custodians for self-directed IRAs. The custodian's purpose is to just hold the funds, handle compliance paperwork, and ensure all IRS rules are followed correctly. They're not meant to give you investment advice on how to get better returns or anything like that. Once they're set up, self-directed IRAs allow you to buy all kinds of different alternative investments beyond just real estate. You can invest in things like precious metals, oil and gas, private equity, and even give out private loans to individuals or businesses. Unlike a normal IRA where you're usually limited to stocks and bonds. Okay, so that explains why you need a self-directed IRA to invest in real estate and how to set one up. Now let's go over the guidelines for putting money into the self-directed IRA account. The contribution limits are the same as a normal IRA at $7,000 a year if you're under 50 and $8,000 a year if you're over 50. But before you actually put any money in the account, you're going to want to establish whether you want this to be a traditional or a Roth self-directed IRA. A Roth IRA means you contribute after-tax money and all the investment growth is tax-free. A traditional, the money you contribute is pre-tax, and when you go to withdraw, both the original contributions and the investment's growth are taxed at that point. Something not a lot of people think about is if tax rates stay the same, a traditional and Roth IRA end up with the same after-tax value in retirement. For example, say the tax rate is 50% for simplicity. With a traditional IRA, you contribute $10,000 pre-tax, lowering your taxable income by $10,000 and saving you $5,000 in taxes today. Later, if you withdraw $10,000 in retirement, you pay 50% tax on that $10,000, leaving $5,000 after tax. With a Roth IRA, you contribute the $10,000 pre-tax equivalent, meaning you pay $5,000 in taxes up front, leaving $5,000 left in the account. When you withdraw $10,000 in retirement, you pay $0 in taxes, essentially avoiding the same $5,000 tax in retirement that the traditional IRA investors save today. So if all else is equal, both accounts give the same after-tax value, the difference is just timing. But some reasons a Roth IRA is usually better is because you're locking in the tax rate now, there are no required minimum distributions, and all withdrawals are tax-free in retirement. This gives you a portion of your money that won't increase your overall taxable income. Plus, the net tax benefit can be greater. Say if you contribute the max limit at $7,000. In the Roth, the tax has already been paid, but the traditional equivalent to $7,000, if it's 50% tax rate, is only $3,500. To fully match the Roth's contributions, you'd have to invest the remaining $3,500 saved in a separate tax-advantaged account. If that's not an option, investing it in a taxable account would introduce tax drag, reducing the after-tax growth compared to the Roth. Also, you are able to withdraw your contributions from a Roth with no extra tax or penalty, just not the growth. For example, if you contribute $1,000 and it grows to $1,500, anytime you need that original $1,000, you can take it out without penalty. You just can't touch the rest of the $500 until retirement. Unlike the traditional where you must pay taxes for early withdrawals and a 10% penalty unless it's one of the few exceptions. But there are some situations that the traditional makes more sense, like if you would rather have the tax break now, you're okay giving up the benefits of the Roth's flexibility, or if you expect your tax rate is going to significantly drop during retirement. Now, if you already have retirement funds, contribution limits don't apply to money being rolled over from normal IRAs or company 401ks. And if your rollover isn't enough to cover a property down payment, you can still keep your self-directed IRA growing in stocks or bonds while making your yearly contributions until you reach the amount you need. Just be careful, once you're ready to buy real estate, make sure you won't have to sell those investments at a loss to cover the purchase. And if you're close to buying or just don't want to invest the money beforehand, you can always keep some or all of the account in cash. Next, let's talk about the rules for actually purchasing the real estate. First, the property must be owned in the IRA, not in your personal name. This means if you're financing the property, it must be with a non-recourse loan. That rules out any type of conventional financing. There's going to have to be a specific non-recourse DSCR type loan. Second, all income and expenses must be paid through the IRA. So including all down payments, closing costs, maintenance, repairs, property management fees, everything. You can't use any personal funds outside the IRA. For the income, all the cash flow and any appreciation gains from cash out refinances or sales must remain in the account. This is where you need to be extremely careful because remember, you can only contribute $7,000 to $8,000 each year. So it's important to maintain healthy cash reserves either inside the self-directed IRA itself or in another retirement account that you can roll over. And you also need to make sure there's cash flow coming from inside the account to help cover those unexpected expenses. The last main rule is no self-dealing allowed. So this means you and close family like spouse, parents, and children cannot live in the property, vacation in it, rent it to yourself or family, or provide any services like doing repairs. The property must be purely an investment. Your in-person involvement should be minimal, mostly just checking on it and meeting tenants or contractors if needed. Then once you go to sell the property, you cannot sell it to yourself or any family either. Now, before we go into using a retirement account to buy a personal home or personal investment, I want to mention another option, using a solo 401k to invest in real estate. Just like with the self-directed IRA, this must stay completely separate from your personal finances, but the solo 401k option allows for much higher contribution limits. A solo 401k is for someone that has a business with no employees except for a spouse. This is typically any type of 1099 activity. The IRS allows these small business owners to open up a 401k for themselves. Even if you have a regular W-2 job with a company 401k plan, you can still open a solo one if you do 1099 work on the side. A solo 401k can either be traditional or Roth, and you're allowed to contribute both as the employee and the employer. The employee limits are $22,500 if under 50 and up to $30,000 if over 50. The employer limit is 25% of self-employment income, and the total between both cannot exceed $66,000 under 50 or $73,000 over 50. Anything you contribute as an employee to your company's 401k counts towards your solo 401k employee contribution limit, but your employer's match does not count toward your solo 401k employer's contribution limit. Essentially, you're the same employee at both jobs, but the two jobs have separate owners. Other than that, most of the rules are the same as the IRA, like being able to roll over money, no personal ownership, all the money has to go in and out of the account, and no self-dealing. Now, I want to give you some things to think about if you're considering investing in real estate inside a retirement account. From what I see, if you don't already have money locked up in these retirement accounts, there's very little benefit from starting one for the purpose of investing in real estate. The reason I say that is while there are very good tax benefits for investing in these accounts, a lot of tax benefits apply to investing in personal rental real estate outside of a retirement account. There's really three big ones that I think about that kind of offset or surpass the tax benefits of the tax advantage retirement accounts. The first one is the active income depreciation write-off. When you own rental real estate, you receive a tax deduction for the value of the building. Now you can either take this evenly over 27 and a half years or accelerate it to take more upfront and have it phase out faster. Either way, 99% of the time, this paper loss is going to be greater than any cash flow you receive from that property. So already right away, the cash flow is tax-free. But the remaining amount of depreciation not used towards the cash flow can be used towards your active income like your W-2 or 1099 job. When you qualify as a real estate professional, you can use this to offset your income all the way down to $0. This is how famous investors like Robert Kiyosaki and Donald Trump pay no income taxes even though they profit millions each year. If you're not a real estate professional, you can still deduct up to $25,000 of depreciation each year against your regular income. If you earn under $100,000, you get the full deduction, and it phases out gradually between $100,000 and $150,000 in annual income. Any unused depreciation can be carried forward indefinitely to future years. Now, this cannot be used when investing inside of a retirement account, only when you own the property personally or under your LLC. So yes, under the retirement account, all the cash flow is still tax-free and you get the depreciation inside the account, but you cannot use that to offset your own personal income, which is a major benefit of real estate investing. The next benefit to think about is cash out refinances. Anytime you want to capture some of that equity growth, these are tax-free as well. And then you have 1031 exchanges. So if you want to sell, you can just buy another property within the time frame and all of those sale gains are tax-free too. So really outside of a retirement account, you're kind of getting better tax benefits because if it's a traditional retirement account, unless you can do a solo 401k, you can only deduct up to $7,000 to $8,000 from your active income. Outside of the account, most people are going to be able to do up to $25,000 and then unlimited deductions if a real estate professional. Then if you compare outside of retirement investing to the Roth benefits, you're still pretty much growing tax-free. Because the cash flow is tax-free, any cash out refinance you want to do is tax-free, and any sale is tax-free if you invest in another property. Really, the only benefit is after 59 and a half, with the Roth, you can sell a property tax-free and put the money in the bank. So if you take these things into consideration, you're kind of getting the best of both worlds investing outside of a retirement account. On top of the fact that you can access profits whenever you want, have better loan options, and have more investing freedom. Really investing in real estate inside of a retirement account makes the most sense for someone who's close to retirement, already has a large balance built up, and wants to diversify beyond just stocks. So for those reasons, I'm going to talk about the best ways to take money out of retirement accounts so you can use it to buy a personal home to live in or to make real estate investments in your personal name or LLC. But first, let me lay some groundwork here. The different methods I'm about to cover are ways to withdraw from your retirement accounts while avoiding the 10% penalty and potentially any income taxes. That said, it's perfectly legal to withdraw any funds you want from your retirement account before 59.5. You'll just owe the tax and the penalty. So if these methods don't give you access to as much as you need, remember you can still take more out if you really want to. Just do the math and see if paying the tax and 10% penalty is still worth it for you. Also keep in mind that the penalty only applies to the amount you withdraw. So if you pull out $5,000, the penalty is just $500 plus regular income taxes. And the rest of your retirement account stays intact with all its benefits. Obviously you want to avoid that by all means, and that's why I'm about to share these methods, but I just wanted to put that out there. Okay, the easiest way to buy real estate using money in a retirement account is to withdraw Roth IRA contributions. So like we've talked about, when you contribute money in a Roth IRA, it's after-tax dollars. So the IRS allows you to withdraw any contributions penalty-free. You can take this money out and do whatever you would like with it, including buying real estate. This, however, is not usually an option with a Roth 401k. The withdrawn contributions will be subject to the 10% penalty. The next best way is using the IRA first-time home buyer exemption. The IRS allows you to withdraw up to $10,000 from either a Roth or traditional penalty-free for the purposes of buying a primary residence if you haven't owned a home in the past 2 years. For the traditional, you'll just need to pay ordinary income taxes. And for the Roth, if the account has been open for more than 5 years, both the contributions and growth are penalty and tax-free under this exemption. The third method is similar to the first. It's rolling over traditional retirement accounts into a Roth IRA and withdrawing the contributions. So this is when you have money in traditional retirement accounts and roll them over into a Roth IRA account. When you do this, you pay ordinary income taxes on the entire amount, both the original contributions and any growth, because it was all pre-tax money. Once converted, the contributions become after tax and any future earnings grow tax-free, just like a normal Roth IRA. You can access the converted contributions, but only after a 5-year period for that conversion has passed. Then just like normal, you can take out any contributions and use the money for whatever reason. Next, we have 401k loans. The IRS allows you to borrow 50% of the account balance or $50,000, whichever is less, penalty and tax-free for whatever reason you would like. How the loan works is the interest rate is fixed at the prime rate plus 1%. And the loan term is 5 years, except for if you're using it to buy a primary residence, then you can stretch the loan repayment schedule up to 15 years. The interest portion of the loan just goes back into your 401k account, so essentially you're paying yourself back. The risk to this is if you miss a payment and default on the loan, the remaining loan balance is subject to income taxes and the 10% penalty. Okay, next is the 401k hardship exemption. The 401k hardship exemption allows you to withdraw whatever is necessary to meet the hardship amount. And one of the qualifying hardships is covering the down payment and closing costs associated with buying a primary residence. But ordinary income taxes do still apply. And the sixth way is taking the SEP distributions. SEP stands for substantially equal periodic payments, and here's how it works. The IRS has specific methods for determining how much you can withdraw from your retirement accounts early without penalty. They calculate your fixed annual distribution based on your account balance and life expectancy. So once you start the SEP plan, after 5 years of receiving your normal annual distribution, you now have full access to your retirement account, even if you're still under 59.5. Now, all the distributions are still subject to income taxes, but as long as you follow the plan for 5 years, there's no penalties involved. You can start SEP for any reason and use all the distributions however you would like. Now, in my opinion, the absolute best approach is to leave your money in your retirement accounts to grow, and then save separately for real estate by using the 4 index funds I go over in this video. And if you need any help buying, selling, or investing in real estate, all my information is in the description for you to contact me.